All right, today saw a continuation of the bearishness we saw post CPI and post FOMC last week. The market's continuing this bearish trend. Nothing surprising. We saw the environment was set up for this kind of move. We've been talking about this for multiple weeks, especially the week before. Not this last Friday, but the last Friday's Market Outlook video. We really set up the case for basically the last 7 days of weakness that we've gotten, and then some. And so we're going to look at those signals that pretty much confirm what we've been anticipating, that we're seeing now, that confirm and suggest that we should expect more. And then we're going to look at how much more do we have to go, and are we close to a bear market low point or not. So we're going to take a look at all that. That's what a lot of people ask, how much further are we going to go down and how long are we going to go down? So we're going to talk about that a little bit today, based off of the signals that we're getting currently and the different stages that different bear markets have. So we're going to break all that down. We're going to take a look at the interesting moves today, especially in the bond market and the sector moves, and kind of where we want to be in 2023 relative in our equity, especially our bulk of our portfolios where we're long equities. So we're going to talk about where we can start to position things for what may be another down year for next year. And then we'll have our trade idea of the day. It's kind of a reflection of the broader market as a whole. So let's go ahead and get started. Today is Monday, December the 19th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Hit the thumbs up icon, the comment on our video, comment on anything that stood out to you. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right. You can come down here on the bottom and click on this heart. It opens up this tab. Hit that like button. Same thing with the Facebook post. Hit the thumbs up icon. You can click that like button as well. Again, you can do this right now while you're watching. It really helps us when you like and you comment and you retweet or share. It helps get our content out to all of our followers on those platforms. All right, let's start off taking a look at the S&P 500 here with the market forecast indicator like we always do. You'll notice here that the S&P has fallen now 3.5% below its 30-day moving average. So it has now eclipsed the 2.5% mark. Again, after 2 days now after getting the bull tag, we've just continued lower. The intermediate line is still rising. That's why it's yellow. It hasn't turned lower yet. We don't have the dark pink shading yet either, because the intermediate line is still at 53. It's got to get below 50 to get dark pink. So you don't quite have the dark pink shading in the red line, but you can kind of see. And probably by the time we will, that's when we'll get a little bit of a bounce. But a lot of people are expecting a little bit of a bounce right now. I expect that we'll probably break through a little bit more. I mean, this is a really important area here, 1320 plus or minus a few points. You got a lot of Fibonacci lines. Remember that? It's a really important resistance area when we were coming up here, and we got that bear tag. Really, really important resistance level. Now it's going to act as a support, and you can see there's multiple Fibonacci lines. The orange line is the year-to-date 23% retracement. Remember, the retracement starts when you get in this case, bullish retracement start when you get above it, and then the retracement ends when you get back below it, and you start a new impulse move to the downside. So we're almost below it. The green line, 38% line, is the current intermediate retracement that we're on right now. The last leg lower. The red line is the 23% retracement of the bullish move since off the 2009 low point. So pretty much this last bull market we've been in. Again, retracement starts when you get below it, and it ends when you get back above it. So we've been kind of had a couple false starts of retracements, and now we're looking potentially to start another retracement and see if this ends up being one that doesn't give us a false start. And then the 38% retracement is the COVID low rally, and you can see that retracement started earlier this year. It had a little bit of a fake out to get back above it, and now we're back down, and and potentially getting back below that 38% retracement level, which we've, again, false started with a couple of times. So lots of really important levels here, Fibonacci support levels, in addition to the intermediate lines almost crossing below its market sentiment line. Without the market sentiment line being very high, that sets you up for a bearish leg lower to the downside, and you can see that's what we're headed toward. I mean, that's what we've been talking about. Like, not this past Friday, but the week before, we talked about the setup that we would be bearish coming out of last week, and we were, and now we're bearish coming out, so far this week, and all these signs are telling us that we're probably going to be bearish here for a while. Like I said, that bull tag, that typically starts the bearish. If we don't bounce, and that was such a big move that it typically starts the bearish runs to the downside. You can see, like the last one did, right there. This move doesn't look as big because there was a bigger gap. This one didn't have as big of a gap to start the session. Let's take a look at the weekly chart, and you can see we got, after a couple transition candles, and last week's being a real significant, like a big transition candle, it's a bigger body than normal. Then now but we did get we got the lower close 2 weeks ago. We closed below that last week. So technically this was the bearish reversal pattern, just had a higher shadow and a lower shadow because we had that bigger move early in the week coming off the CPI report. This is the more typical bearish candle, easy close, lower close. The PPO is falling. We got the red arrow last week. Things are looking pretty bearish on the S&P. If you're looking at the three green arrow chart, we have 3 red arrows all across the board. It's been now however many days for the Russell. It's been a long time for the Russell, so easily established. 3 days now for the S&P and the Dow. We're pretty well established there now because it doesn't look like we're going to get back above those anytime soon. And then the Dow, that would be the Nasdaq and the S&P, and the Dow is also 3 days. You had 1 day. You had 1 day here in the middle that we had got the green arrow, but now we're back to the pink shading, so it's trying to get itself established again, just like these others. So pretty well established. You can see when you look at this chart, we are obviously well below the 30. The 8 and 17 day are now below the 30. That's a significant cross. Price is now below the 50. And your 8 and 17 day are working down in that direction as well. We're below the point of control for the year chart. Those are pretty bearish moves. The Qs obviously is much more bearish. Already is below its 50-day moving average. Already is below that 23% retracement level for this current intermediate decline. Well below the 23 for the year-to-date decline. So we are on a new impulse move, and for the Nasdaq, also below the point of control for the year. The Russell 2000, we're almost below that 23%. We are well below the long-term 23%, already below the 50 as well. Well below the point of control, well below the value area, and now easily below the value area. So you see the breakdowns. The diamonds is the only thing that hasn't broken down as much. It's sitting at its 15,200, but you can see once it breaks this level, there's going to be a pretty decent free fall on the Dow. Because remember, all the other indexes are right around their 23% retracement of the current, basically down here. The Dow has got that much to fall, if it falls, right? It's obviously also below its point of control. Its 8 and 17 day are also crossing below the 30. So we do have a significant reversal here. And like I said, things will get a lot worse for the Dow once it breaks its 50 and 200 day moving averages. Essentially to catch down to where the other indices already are. You've got easily above 25 on the negative indicator, or actually well above 30. Your positive hasn't dropped below 20 yet, which again suggests how much downside we have left, because we haven't even started to sniff the beginnings of it. If you look at, like we talked about, the McClellan oscillator getting below the negative and then getting below minus 35. Well, now it's easily below minus 35. It's well established. We're almost back below 0 on the summation index down at the bottom. Your money flow index is also down below 50, easily now in the bearish territory, below 40. So, I mean, we are pretty darn bearish here. The money flow itself is already at its low of the year, even though you're not even close to touching the lows here. Again, this shows how bearish we are on this. Looking at some of the other oscillators, the RSI and the CCI are in the bearish levels. In the lower half of the charts, the RSI did get below 40 now. CCI did get below minus 50, so they're established in bullish levels here. Looking at the stochastics, obviously well into bearish territory. Extreme lows again for 3 consecutive days for where we are closing relative to the range. I drew these lines here. These are based off the last legs lower here, and to kind of give an idea of where and how, where we might get down to. So I think this one's the first move, this one is the second move, and then this one's the third move. So if we were to replicate this first move, which again the VIX was really low then, so it's highly doubtful we'll replicate that move. But if we were, we'll get down to around to the pre-COVID highs. That's about where the pre-COVID highs are, a little bit lower, by the beginning of February. If we replicate this last move, which is this third one, then we'll get down to 3,200, 3,265 down these Fibonacci areas right after January expiration. So very, very end of January. And then this one is the second move, the one in the middle. That one gets you down to 3,100 by the middle of February. And that one's pretty likely too. So, and you can see we're pretty much on pace right now for all 3 of them. Coming off of this peak, we're pretty much still on pace, as bearish as we've been, for all 3 of these to be a possibility. So that kind of gives you an idea of where we might be headed towards in the next little bit. Let's take a look at let's see here, the Bollinger Bands and the Keltner channels. And we did not close below the lower band. We have been flirting with it all day. We were flirting with it too on Friday. You can see we came really darn close. The bands are breaking out. In fact, you can see the bands have broken outside of the Keltner channels. And we are trading outside the Keltner channel, just barely, but we are trading now outside the Keltner channel. So very bearish signal here. And considering how low the bandwidth is and it's rising, we are looking like we're at just the beginning stages of this decline. Obviously, we got a new 4-week low. We had that before, so we hit this on Thursday. We got the Arun indicator hitting up to 100. It's still there at 100. The positive is still above 70. Remember, it's got to get to below 0 before we even start thinking about a low develop. So, and the bandwidth itself has to usually get it well above 10%, if not up to 13, 14. We were kind of running the numbers on that as well. Getting from these highs, from the current high point down to about 13% would get us down to around 340 in this area. And of course, it's usually when we do get up to these high levels, the green line has already hit 0. So the high tag this high tag will be well off the chart and will be moving. You see, once this comes off, the high will be moving down. So by the time we do get to 13, the high that we'll be basing that off of will probably be one of these highs, which that now starts to put us down towards 3,200 as well. So again, very likely, and that's the target I've been talking about for a long time. I know a lot of people have been talking about 3,200 as a target for the end of the bear market. That's the end. From my opinion, it's actually the target for this transition stage, right? That third leg lower. The first leg is the pullback down to the 50, maybe below the 50, and then the failed bounce. Then the second leg is the pullback to the 200-week moving average, and this we had 2 kind of moves there, and then 2 failed bounces, both of them getting to the 50-week. And then the third one is a transition stage, the move down to and through the 200-week moving average that transitions us from a bull market correction like we've had so many of before in the last so many years to an actual bear market decline. Again, bear markets don't start until you're trading below the 200-week moving average. We haven't traded below, maybe a few days. A handful of days this year is all we've traded below the 200-week moving average. So when we're in a bear market, you'll spend months below it. Not even just a few weeks like we did here in COVID. That was just a deep correction. We're talking a bear market, you'll typically spend months below it. We have only spent a few days. So more than likely, we are going to spend months below it into 2023. And right now, we're working on our move to and through that 200-week moving average. And 3,200, in my opinion, or the pre-COVID high here at 3,400. These are the two areas, best case and worst case scenario, for how far we'll drop on this stage. Then you typically get a return move. Again, going back to the 2008 example, since it's the most recent one, then you get your return move back up towards the moving average, and then the bear market really kicks in gear, right? That's a bear market. This is a bull market correction that ultimately failed, and then the transition stage from a bull market correction to a bear market, this is the bear market, right? This here, and that's what we have to look forward to, in my opinion, in 2023. So you can see, like, we are just starting. Like, if we were, again, if we're going to get if we're going to get this range up towards the 13, 12, 13, 14%, then it's going to be coming off of much lower highs in 410. It's going to be down towards 380 and, in this area. And then, of course, now we're looking at a range, that would put a low point right around the 3,200 area. So that's on the radar. Let's take a look at the VIX. If we take a look at the VIX here, you can see that the VIX hasn't really rallied. It's still actually below 90%. The VIX itself, here, let's take a look at the daily chart. It's still at 22, so it's not jumping. No matter how bearish we are, it's not jumping. And that tells you, again, just how much bearishness we have left. Because if this is not going to rise and the VVIX isn't going to rise, and that's what this chart, remember, measures the correlation, then, again, a negative correlation or even a low positive correlation, lower than normal, sets you up for a jump in both the VIX and the VVIX. So as bearish as we've been so far, we still haven't gotten the jump in the VIX that typically correlates with these kind of moves. So that kind of gives you an idea of how easy it's going to be still to move down to 3,200. We've been converging this whole time on the VIX. So it's setting up for that move that we have not experienced yet, despite the fact that we've gotten the bull tag and how bearish we've been. We just haven't experienced that move yet. It's still coming. All right, some of the other things that we look at that I've shared with you before that kind of signal the bearishness. So we talked about a couple weeks ago when we talked about the possibility of us being bearish. The new highs and new lows are well below the average. The average is now declining again. A hallmark of a decline, leg lower, is for the new highs and lows to be below that average. So we're definitely, the skew also has dropped back below after spiking, and this spike was worrisome. And then we brought up this second spike here. Now we're looking at a new leg lower. We're back below this average, so we're looking at a new leg lower on the skew. The new highs, or the number of stocks above the 200-day moving average, has dropped back below 50%. Again, that's relatively bearish. Typically coincides with these legs to the downside. If I were to go out 20 years on this, you can see the mean is still relatively the same, right around 65. But you can see that you only get below 50% on the bear market moves, right, or the corrections. You can see the significant corrections, and here we are again back below 50. Now, if we can keep it short term, great. But failing at the mean, not getting back above the mean, and then getting back below 50, just like that, that's a pretty decent indication that we are starting the bear market, right? We are transitioning from the two early stages of the bear market, the pullback stage and the failed pullback bounce, the correction stage, the failed correction bounce. Those are the first two stages of the bear market. The third stage is that transition stage from the bull market correction to a bear market. That's the stage we're in right now. Because typically corrections bounce to new highs. That's why Tom Lee's so popular, because corrections typically bounce to new highs. We had a correction to the 200-week moving average. Odds are we bounce to new highs. That's that he called the COVID bounce up to new highs. That's why he's so popular. But the odds are that's what happens until you have a bear market. And there's literally only been a handful of bear markets since the 70s. 1973, 74, 81, 82, 2000, 2002, and then 2008, 2009. I mean, those are the literal handful of bear markets. You can throw in like 78, 77, 78 in there, but it was really small You can try to throw in like the 87, but that was more of like a COVID type move. Obviously, COVID, a lot of people consider a bear market, but again, pretty deep correction that just happened to get the 200-week moving average. Everything else are just corrections. So corrections bounce to new highs, as we've seen over the course since 2009. 2011 correction, 15-16 correction, the 2018 correction, the COVID correction, they've all bounced to new highs. Until when they fail, they start bear markets. And it appears to be what's happening right now based off of the indications we've seen in other bear markets, right? Again, a pretty similar bear market this go around to what we saw in the mid-70s, in that you have, again, the Fed raising rates during the correction and during the transition stage. The Fed still raising rates. That wasn't the case in 08. It wasn't the case in 2000, 2002. It was the case in 73, 74. They were raising rates in 73. The market spent the whole year in 73 above the 200-week moving average, got below it at the very end, then spent all of 74 below it. Very similar. And the Fed stopped raising rates at the end of 73. They're going to stop raising rates here pretty soon, and we're going to spend probably most of 2023, if not all of it, below the 200-week moving average. Again, very similar to those levels. And we would like to avoid the correction / bear markets that came after that in the late 70s and early 80s because of the second spike of inflation that we got because the Fed stopped raising rates early. So that's why Powell brings it up so much. And the Fed still widely expected 100% odds that they'll raise rates to 4.75%. There's a 35% odds that they'll raise rates to 5% at this next meeting, in the February meeting. And the odds of us getting to 5%, let me just refresh this page here. The odds of us getting to 5% have been above 60% for a good chunk of time. And generally speaking, when the odds spend a good chunk of time above 60, because that's relatively high probability, 80% is like baking the cake, 60% is relatively high probability. So when it spends some time up there, and it's not just kind of like a one-off thing, then it generally will get back there, and then get back above it, and then eventually get to 100. It's not very common for it not to do that. So here, yes, we've fallen here lately, but don't be surprised if it ramped back up. I would not be surprised if the Fed raises rates to 5% and then finishes raising rates in February. And by then, you've got an 82 basis point spread between the 10-year and the 3-month. You've got a 100 basis point spread between the Fed funds and the 10-year, right? Almost 100 basis points. So you can see this is starting to rise again. And then we got a 66 basis points. So you can see the inverted yield curves are telling us that we are most likely headed towards a bear market. You can see the 10-year yield, as I mentioned, is starting to rise up again. Again, people are selling long-term bonds because they can get much better returns than the short-term paper. So not surprising, we've been converging here. This is the first day now that we've been at least at the 17-day moving average. We expect that we will get above the 17-day moving average. Rising yields, as we've seen all year long, has been bearish for equities. The TLT did drop below its 17 after converging for a while. For about a week, it's been in convergence mode. Now it's finally in divergence mode, right, where we're going to be below the 17-day. We're back below that 23% retracement. We're in that bearish pattern, and bearish stocks and bonds have been moving together in this inflationary environment here. Looking at the dollar, a lot of people have been kind of watching the dollar there. It did drop, but you notice that we are also in a convergence mode there. We're sitting at the point of control. We're sitting near the 200-day moving average. So we'll see how much we end up dropping. You can see we're at the 50-week moving average here. If and when we're going to base, the histogram's already peaked, so you'd expect the MACD the histogram's already bottomed. You expect the MACD will bottom here within a week or two, and then it's a matter of how much further this dollar's going to go up. We'll see, right? We'll see, especially if they start to anticipate a more restrictive Fed than what they're trying to price. They're trying to force the Fed's hand, and so far the Fed has not been taking the bait, right? They've been continuing to keep the pedal to the metal, so to speak, to try, their main thing is that they can't get the unemployment rate to rise, which is what they're kind of hoping to be able to stop all this demand that's out there and bring the demand down to the supply levels so that we can get prices down. Emerging markets did well today. The weakness in the dollar really helped emerging markets go up. International stocks have just been killing it. You expect that they will continue to kill it. Right? If you look at the relative rotation graph for these areas and just kind of look at the main, we'll do SPY, EEM, EFA. Let's do VTI and VXUS. We'll put these on here, kind of these major asset classes, and we'll do them relative to VT. This is the global equity. You can see that a lot of this, like commodities, are moving down to the left. Global bonds are starting to move up a little bit. Corporate bonds moving up a little bit. But look at VTI is U.S. equities. VXUS, or international equities, are just killing it. If I were to separate out EEM and EFA from that VXUS, EFA is just what's really been killing it, and EEM is starting to ramp up too. As you saw today, it's starting to really ramp up as well. So international equities are going to be the place to be for most of 2023 because international equities, and it's been something we've been talking about at Market Scholars for quite a while, international equities have the far better margin of safety than what you see in the U.S. Let's refresh this page. In the U.S. as well, even relative to those developed markets as well. Here we go. So you can see Japan and Europe are these two lines right here. Brazil, China, Korea are kind of the main emerging markets down here at the bottom. And then you can see the U.S. So if I go all the way to the very end, so basically to the end of November, USA is at 29 on the Cape, and China and Brazil and Korea are in the low teens. So the U.S.'s Cape rate ratios are more than double. We talk about, that move to and through the 200-week moving average that we're expecting SPY to ultimately get to transition into a bear market mode. Well, if you look at VXUS as a whole, we can see that already happened last year, right? The international equities have been in the bear market, and they've kind of made this little run here lately up towards their point of control for the last 20, or at least since this was made. But if I go back to like EEM by itself, EEM has been in the bear market already. Has been down. It got through. It made a little return move. It's been down. We are at that 30-week moving average right now, and but there's this has broken down already. EFA hasn't been as bad, but still made its way back up to the 200-week moving average. But still, it is there, right? It is at the 50. It looks like it's starting to fail down here to the downside. So with the 8 and 17 week crossing up above, so you can see they've been in the bear market already. The U.S. you expect is probably a year, 9 months behind where they're at. So they have a much, much, much better margin of safety. And then let's look at how the sectors performed here, and look at their comparison chart. Let's actually come down here. Sector comparison. You can see that we are today was we were down today. Here, let's go to, this is a 3-month chart. Let's go to today. You can see what's going down here in the last 3 months, but I want to look at just today. You can see those cyclical areas doing really well, and I'll show you the relative rotation here in just a minute. But look at staples, healthcare, financials, and industrials holding up, energy holding up, utilities, of course, your safe haven, and those cyclical areas. XLY, XLC, XLK, all really getting hit pretty hard today. If you look at the relative rotation graph for these different sectors to see which ones are moving up, which ones are moving down, materials and industrials have had the strongest momentum. Financials, those are all kind of the cyclical areas. Energy, industrials, financials have had the highest relative strength among those. So again, kind of cyclical nature of these sectors. Discretionary has the lowest momentum. Utilities has low momentum. XLC has low momentum. But utilities and real estate are really picking up their momentum rather rapidly. They have the bigger, some of the bigger moves. Energy is really losing momentum rapidly. And you can see kind of a shift towards XLK is kind of grinding up for really low moves relative to especially where XLK and XLU are moving. XLP is starting to move up as well. So you can kind of see the rotation is shifting from these cyclical areas to, there's energy down there. There's financials kind of ramping up there. But right now, healthcare staples and utilities are your three biggest momentum and your three biggest relative strength on the daily chart, along with real estate. So these are your typical safe haven asset classes. That's where we're moving towards, and that's where you'd expect would start to move towards more on the longer term basis as well. All right, so now let's take a look at our trade idea of the day. And I want to take a look at XLI. XLI, like I said, one of the more bullish, one of the outperforming industries relative. I mean, still down, but relative to all these other sectors. But again, this is a pretty good reflection. XLI is a pretty good reflection of the market because that's pretty much where the strength of the market has been. And look at this bull tag that it just barely got Thursday, and then now you can see the continuation the past couple of days. The intermediate line just barely breaking below market sentiment. And its market sentiment line had been relatively higher. Short-term sentiment, we're now almost 2.5% below the moving average. I mean, we are showing some bearish signs. I mean, very similar charts to what the broader market. You can see, again, we got the lower close. We confirmed that with last week's close down below the body. And then now this easy bearish candle here. Don't quite have the red arrow yet. It's been off and on all day, so we'll see. It's only Monday, so we'll see by the end of the week if it ends up staying on there or not. If you look at the moving averages, obviously we just broke below the 17 and the 30-day moving average on Thursday, and now we are easily, which happens to also be the point of control, which is a scary thing about this chart is because we moved up so far so fast, it's really top heavy, and there's not very much volume below. All the volume is above us. There's one big node for the whole year, and it's a pretty skinny node, and it's right above us. So we broke back below this 23% retracement line, back below the point of control. The MACD and stochastics are turning negative in bearish territory. All these other oscillators are also turning negative. It had such a bullish trend, such an extremely bullish trend that's now broken. Your rate of change has turned negative finally. It's the first day that the rate of change, the red line's been below price. So it's easily below. Obviously, it's well above the cloud, so it's still got some room to turn lower. You can see the RSI and the CCI breaking the lower halves of their charts. Again, very similar to the broader market. If you look at the Bollinger Bands and the Keltner channels, we are easily in the lower quartile. Again, breaking below the point of control. The bandwidth is starting to rise. The bands are not quite out of the Keltner channels yet, but you can see they're working in that direction. So there's a lot of bearish signs here, and so what I decided to do on this trade is very similar to what we've done in others. Is do a bear put spread, buying 95, so buying that mid 30s delta, going out $2.50 wide, position sizing for a half a normal position because it's a directional lower probability trade. But getting about a 3-to-1 reward to risk ratio if it ultimately does work out in that favor. So again, buying an out of the money put for 30 days out. But you can see if you go 30 days out for XLI, I mean the one standard deviation move is getting to below the value area at 90. And again, typically when you fall, it doesn't just fall one standard deviation. So I'm feeling pretty good about the possibility of getting a pretty decent reward for a small amount of risk. In fact, it's already down since we put the trade on at the end of the day, right when we put the trade on at the end of the day here. So it's already, we did it during the Market Outlook Live that we do for our subscribers on our Market Scholars website. So since we put this trade on in the last half hour of the trading day, that's how much we're already up since we've been in it. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Like us on Twitter and Facebook as well. Join our website for free. That allows you to be able to participate in that particular Market Outlook forum, as well as other things. Have a great rest of your Monday night, everybody, and we'll see you all next time.